Hey everyone, welcome to another episode of Boss Economics World, where we reveal the hidden truths behind the polished numbers and well-dressed lies of governmental economic policy. Today, we're diving headfirst into the smoldering economic battlefield of Europe, France, Spain, and the Eurozone as a whole, where the headline says inflation is declining, but beneath the surface, the real economic dangers are just starting to bubble up. And let me tell you, while central bankers and politicians pat themselves on the back for CPI reports coming in below expectation, they conveniently ignore, or maybe they just don't understand, the massive systemic problems brewing underneath. So, put on your economic seatbelts because we're about to expose why this so-called cooling inflation could actually spell disaster for both the Eurozone and global markets. Let's start with the latest numbers. In September 2023, inflation in France came in at just 1.5%, and in Spain at 1.7%. Immediately, all the big money investors started whispering about how ECB rate cuts are coming faster. Markets, well, they're drooling over the possibility, like dogs being promised a buffet. And why? Because, supposedly, falling inflation means the European Central Bank, ECB, can begin cutting interest rates, which they've already done twice this year. Investors are betting on another quarter-point cut in mid-October, pushing down the cost of borrowing and making stocks, real estate, and other assets pump up again. But wait, ask yourself this: why is inflation deflating so rapidly? It's not because the European economy is suddenly healthy. No, it's because the wheels on the economic cart have come dangerously close to falling off. You guessed it. The purported hero of today's inflation numbers is a fall in energy costs. Why? Because prices of fuel, natural gas, and electricity have cooled off from their stomach-turning highs of recent years, rather abruptly. But this isn't good news by a long shot. First, let's not forget that Europe's energy market is still highly volatile. The price collapse in the energy sector comes after an extraordinary boom, driven by the Ukraine-Russia conflict and the subsequent supply chain chaos. A part of the drop can also be attributed to weaker global demand as industries across the board are announcing slowdowns and layoffs, which is hardly a badge of honor for a healthy economy. Meanwhile, other big-ticket costs like food remain high, and rent, through the roof in many European cities. But here's something scarier: we're already seeing contraction in major sectors, and this decrease in inflation shows us the demand side is collapsing. You know what that brings, right? A recession. Forget the champagne, this is not a time to celebrate, folks. Meanwhile, while inflation slips below 2%, Germany reports rising unemployment for the month. Once again, more than expected. The situation in Germany is critical and signals the first real crack across the Union. Germany, historically the economic engine of the Eurozone, is flashing some very alarming red lights. Unemployment is going up, and the recent figures showing a dip in various industrial outputs are only going to make this more of a trend. Look, folks, unemployment never rises unexpectedly if the economy is doing fine. Remember the famous recession thermometer. When unemployment rises alongside lower inflation, it's not a quirky one-off. You're looking down the barrel of a serious economic slowdown or even a collapse. Unemployment data doesn't lie. Employment, or lack thereof, hits people in the face hard and fast. And when the biggest economy in Europe sneezes, the rest catch the flu. Let's stop here for a second. The ECB has an official inflation target of 2%. But what happens when inflation dips below that threshold, especially when core sectors like services are still running hot at 4%? Now, this is where the policy tightrope walk begins. The ECB, led by the likes of Bank of France Governor François Villeroy de Galhau, is torn between cleaning up inflation and averting a full-blown recession. Villeroy, like many cautious central bankers, warns against racing to cut rates, favoring a more gradual approach, and not cutting too eagerly lest they undershoot their inflation targets. Well, guess what? They're already late to the game. Look, during periods of high demand and rising wages, you aggressively raise rates to cool down inflation. But what if you've done that and now the demand is falling off a cliff, as evidenced by contracting private sector output, and unemployment starts creeping in from the shadows? Well, what can they do now? Lower rates. That's the prescription. Because the European economy is now dangling dangerously close to a sharp recession, rates will indeed be slashed faster than central bankers would like to admit. The tide has turned. It's no longer about how fast inflation is rising, but how slow the economy is growing. There's another issue everyone seems to gloss over: The ECB's own projections suggest that while inflation might peter out towards their target by 2025, they also hint that prices could pick up again. What does this mean? Well, they're paying attention to services inflation. Unlike energy costs, which are volatile, services inflation tends to be stickier, meaning that once those prices go up, they stay up. Services inflation was running at a hefty 2.5% in France and over 4% across the Eurozone. Factor that in with a hefty chunk of the population feeling the weight of unemployment and will see consumer activity slow way down. This creates a nearly impossible situation for the ECB. Do they prioritize preventing a recession, risking another round of inflation? Or do they keep tightening, rip the Band-Aid off, and let millions of people, especially in weaker euro area economies like Greece and Italy, feel the full brunt of that decision? Here's a clue. Historically, central banks fail at fine-tuning markets. Macroeconomic policy at this stage is a fire hose. And Europe's economy? It's the fire. So let's wrap this up. What does all this mean for you, whether you're a small investor, an everyday worker, or a professional watching markets like a hawk? If you're holding assets in the EU or watching for indicators of global contagion, brace yourselves. The ECB will have no choice but to cut rates, and soon. The banking sector might enjoy a temporary sugar rush, but you don't get free money without major long-term consequences. A rising unemployment rate, combined with slowing economic activity, teeters on the edge of what could be a deflationary trap. And we all know what deflation means, right? A complete economic standstill. The cold truth is that Europe at large is operating under fragile conditions. That's why whenever you hear about lower than expected inflation, know that it's tied to underlying weakness. Don't be distracted by the shiny chart. Be prepared for a slow grind into a Eurozone recession, which could spill out to other regions post-haste. And for Europe's politicians who have long relied on monetary intervention to bail them out, those days might be numbered, unless they find new ways to revitalize demand, encourage job growth, and counteract the broader trends of slowing economic activity in both Germany and France, arguably the two heavyweight economies of the EU. In conclusion, I hate to be the bearer of bad news, or as many public officials would pretend, pessimism for the sake of clicks, but France and Spain's recent inflation dip signals something far worse than economic recovery. It's the symptom of a deeper disease, a faltering economy that has been running on borrowed time, cheap energy, and government stimulus. As inflation drops across the Eurozone, the investor's quick interpretation of inflation relief overlooks the long-term danger of growing unemployment and rapidly contracting industrial outputs. And so, my friends, this isn't the end of our journey. It's just the beginning. The European Central Bank will be navigating treacherous waters, and the price paid for their intervention will only become clearer as time goes on. But for now, buckle up, we're in for a rough ride. If you found today's breakdown useful, share it with those who care about where our money, jobs, and future are heading. Turning a blind eye won't save us from economic disaster. Stay informed, and I'll see you in the next episode of Boss Economics World.